Good morning, everyone, and welcome to our DAT IQ Weekly Market Update. This is our update for June 7th, 2022. I'm Ken Animo, Chief of Analytics here at DAT, joined as always by Ned Damon, who's our Principal Data Scientist, and Dean Croak, our Principal Industry Analyst.
Yeah.
Wow, I'm a little rusty after that week off. New headset, I don't know what's going on.
Good morning.
Good morning. Well, Ned, we have a movie star in our presence here. We have production quality Dean Croak.
He's always production quality.
That's true. I hope he doesn't get too big for our weekly show. That would be would be sad. And what I'm alluding to is we have a really cool video that was shot and assembled by our, I don't know what the technical term is, edited, I don't know, produced by our production team at DAT from the MidAmerica truck show a couple of months ago. And we're going to roll that right now.
So welcome to the 50th anniversary of the MidAmerica Truck Show. This is the premier truck show of the season, and for me, being part of the trucking industry and having a show truck and working in and around all of my friends here at the MidAmerica Truck Show helps me stay grounded in what's really going on in the industry.
Been coming since 2018. I've always heard about the shows and I've never went, heard about all the fun, the people, just the atmosphere of what you get here.
I love being here. It's so many vendors here, built so many relationships, talked to so many companies.
I found out about DAT and MATS in 2018. I was still a company driver, so I was here soaking up information and just trying to figure out what's the next step as an owner-operator. And I remember coming by your booth.
That was really awesome. We were excited to show that. I think it just shows the presence we had at the MidAmerica Truck Show, sponsored that big concert, gave away a signed guitar, supposedly. I wasn't able to join this year, but really cool stuff. But with that, we're going to move away from Hollywood Dean Croak. We'll get back to him in a minute, and I'm going to cover our key points of the week. So I think some good news out there. Dry van spot rates have been holding their ground a bit. I think we're really kind of paying attention to the next 20 to 30 days, how those rates fare compared to an 18 comparable. Dean will cover that more in a minute. Contract rates, again, as we would expect, given the corrective cycle in spot, are beginning to lose steam. Shanghai reopening. We've got West Coast volumes down 8% month over month and East Coast down 1%. New truck orders down, but transportation employment numbers at an all-time high, up almost 23,000 in May. So with that, I will turn it over to Dean to walk through our market update. Dean?
Yeah, thanks, Ken. Short work week last week, so a lot of our numbers were thrown off a little bit by the four-day week, but typically we see volumes drop off. Some carriers stayed on vacation anecdotally this year, a little bit more than last year, according to some of my research. So the load-to-truck ratio in dry van dropped to 4.34. It's about 9% lower than this time last year. In the refrigerated sector, clearly a much cooler start to the 2022 season. We'll talk about that a little bit later. Hopefully it could be offset by a much hotter grilling season this year. Some of the research that our lead researcher, Christina Ellington, did shows that grill sales and grilling out are expected to be at or near all-time highs this summer. So there's still time for reefer volumes to pick up, even though produce volumes are down. Last week, we had 20% fewer load posts last week, so the load-to-truck ratio dropped down from 7.6 to 6.77 loads per truck. In flatbed, more carriers took time off last week. Certainly more construction workers take time off last week. During that short work week, load post volumes dropped about 31%. We had 14% fewer carriers posting their equipment. As a result, the load-to-truck ratio was 60.07 last week. Having a look at our market condition index around the country, focus this week is a little bit on some of the intermodal markets, in particular the West Coast, where rail capacity and increasing container dwell times in the Port of Los Angeles and Long Beach are resulting in a repeat of what looks like last year, where truckload carriers picked up a lot of the excess volumes as shippers, I guess, were frustrated by some of the delays at some of the big ramps like Kansas City, Memphis, Chicago, and the West Coast in particular. So in the Los Angeles market, dry van spot rates were up for the fourth week in a row following last week's 1 cent per mile increase. The average was $2.19. Imports overall are starting to pick up 3% month over month and 6% year over year, according to IHS Market Peers data that was released yesterday. Volumes on the West Coast are up 8% across the entire 29 ports. In Los Angeles and Long Beach, 11% and 14% up month over month. So import volumes are starting to pick up there, and we're starting to see capacity tighten a little bit, although rates are way down compared to this time last year. For example, one of the benchmark lanes we look at in terms of the impact of imports is Chicago out of Los Angeles. Truckload competes heavily on that lane. The 6-month slide in spot rates, line haul spot rates, excluding fuel, that is, it was corrected last week, increased by 1 cent per mile to 165. Important to note that's still 89 cents a mile lower than this time last year, and of course that's significant. There was a lot more congestion, a lot more volume last year, and that's the big question we're remaining to answer to see whether import volumes do pick up this year. Further inland at some of the intermodal hubs where there's increasing congestion and grounding of containers, not putting them on chassis trailers due to the shortage, Joliet and Chicago, truckload spot rates are following the same 4-week trend as Los Angeles, up to $2.29. Same for loads Chicago to the northeast intermodal hub in Worcester. Rates on that lane increased 11 cents a mile to an average of $2.59. Interestingly, they had been decreasing for the 5 months prior. And in the Midwest hub, intermodal hub of Kansas City, rates increased for the 3rd week in a row to $2.11. Capacity very tight from Kansas City to Lakeland, another intermodal lane, rates averaging about $2 a mile there. So lots of truckload tightness around some of those big intermodal hubs throughout the country. Produce volumes, we talked about that at the start of the show. Volumes are down the equivalent of about 30,000 truckloads per week as of last week. About 20,000 of those loads come from California alone, so we're off to a pretty slow start. Spot rates in the state of California have been steadily rising, though, averaging $2.54 this week. But they're almost $1 a mile lower on some of the key lanes, just to emphasize how low reefer rates are this year. Chicago out of Fresno, it's exactly $1 a mile lower. Fresno to Hunts Point in New York City, averaging $2.35. That's $1.09 per mile lower year over year. These are line haul rates excluding fuel. Fresno to Lakeland in Florida, similar trend, averaging $2.26, down 88 cents a mile. There was a late surge in produce out of Mexico, so we saw some impact in Laredo, one of the biggest truckload crossing markets. Last week's spot rates out of Laredo jumped 20 cents a mile to an average of $2.73. Loads 1,200 miles east to Atlanta were paying $2.84, about 10 cents per mile lower than the week before. Loads north to Chicago, they were down 5 cents a mile to $2.37. And in Houston, capacity tightened again. Spot rates are up 25 cents a mile to $2.56 for reefer imports. Having a look at the flatbed market condition index, we're having a look at our Houston markets, our largest flatbed market. Last week, spot rates increased about 25 cents a mile on average to $2.56. Number one lane out of Houston is Fort Worth, 270 miles to the north. Spot rates hit a new 12-month high, averaging $4.02. That's line haul spot rates excluding fuel at $4.02. It's about 89 cents a mile higher than this time last year. Loads from Houston to New Orleans up 10 cents a mile to $3.16, while loads to the flood-ravaged Miami City last week hit a new 12-month high of $2.95. Capacity is still very tight in the Pacific Northwest. Flatbed capacity was tight last week following the 18 cents a mile increase to an average of $1.71. Having a look at our year-over-year look at spot rates, excluding fuel, have been flat for the last 3 weeks after dropping 72 cents a mile over the prior 9, slightly up, probably somewhere between half and a penny per mile last week, it looks like, is how it's going to end up. But essentially, they've been holding their ground for the last 3 weeks. Of course, we've been anxiously awaiting the seasonal correction in spot rate decline. It may have finally arrived. Time will tell. Spot rates normally increase by as much as 30 cents a mile between now and July 4, so based on previous pre-pandemic years. Last week's slight increase, the national average ended the week at $2.06, excluding fuel. That's 29 cents a mile higher than last year and about 12 cents a mile higher than 2018. In the refrigerated sector, produce volumes are down about 16% compared to last year. Substantially lower volumes in nearly all of our major markets. We're moving about 1,000 loads a week less out of the southeast, about 20,000 loads fewer out of California nationally. So a lot less volume. So as a result, the national line haul average for reefer ended the week at $2.33, down 3 cents. That's about 84 cents a mile since the start of the year, but almost identical to where reefer spot rates were in 2018. Looks like a good year for comps. And wrapping up with flatbed, spot rates remained flat last week, ending the short work week at just under $2.65 per mile. They're now 6 cents a mile lower than last year and about 10% or 24 cents a mile higher than 2018. So that's it for this week's market update. If you'd like to find out more about what's happening in freight, go to dat.com/market update and download our long form weekly report, which is published on Wednesday evenings. And with that, it's over to Ned for the short-term forecast.
Hello, everybody. We're going to begin by looking at the dry van forecast. Since it's been a couple of weeks since we've looked at the forecasts, the numbers may shock and astound you, but I can promise that it's all on the up and up. So starting with dry van in blue, we have the market rates observed by DAT. And then off to the right, we have our forecast models. In red, the short-term model has changed since the correction that happened back in the middle-ish part of May. The short-term model has become much more bullish and is expecting rates to rise by, if I'm looking correctly, about 30 cents over the next month. I think that's maybe a little aggressive. In contrast, Ratecast expects rates to maintain about their current levels for a couple of weeks and then raise by about 5 to 7 cents a mile as we move into the July 4th period. And that Ratecast forecast is in green. Our blended forecasts in gold and silver are mixtures of the two forecasts in different amounts and in different ways. They're feeling a little bit more like the short-term forecast, but I think the upside is maybe a little bit smaller than the downside moving forward. Moving on next to the reefer forecast. In blue, you can see the market rates observed by DAT. And then off to the right, you can see the forecast models, which are in pretty good agreement for reefer, which I like it when my models agree. Gives me a little warm fuzzy. In red, we can see the short-term model, which is expected to rise by about 20 cents. Wow, that's substantial. Over the next month, with July 4th and produce volumes, seasonal trends being the biggest single source of that. In green, the Ratecast model is expecting rates to rise by a fair bit less, maybe about 7-ish cents, if I'm reading correctly. With a downward trend overall as we exit into the July 4th period. That is, it's going up, but then the trend is downwards. Finally, the blended forecasts in gold and silver, which are mixtures of the two forecasts in different amounts and in different ways, are basically tracking with the Ratecast forecast, expecting rates to rise, but then to start to level out and head down as we head into that post-July 4th zone. Finally, for flatbed, this one's a little surprising for me, but it's overall interesting. In blue, you can see the market rates observed by DAT. And then off to the right, you can see our forecast models. In red, the short-term model is once again the most bullish of the bunch, expecting rates to rise by 7 cents as we move through the next period, ending on about July 4th. And in contrast, the Ratecast model also agrees with the directionality, although it's a little more muted in its expectations, with rates rising by a net of 5 cents as we head into July 4th, with the downward trend starting a little bit earlier for the flatbed model than for some of the other models. And that Ratecast forecast is in green. The blended forecasts in gold and silver, which are mixtures of the two forecasts in different amounts and in different ways, are once again tracking closer to the Ratecast forecast, expecting rates to rise by about 7 cents before leveling off a penny or two as we head into July 4th. And with that, we're on to our delightful IQ question of the week, which is, what should we expect in the next month leading up to Independence Day?
What should we expect in the next month leading up to Independence Day? That is the question. Well,
yeah, I could maybe give you some stats to speak to the demand side, if that'd be a good way to
absolutely
segue into the rate change. We pulled some of the data from the USDA for things like the volume of meat, dairy, poultry, fruit, vegetables in cold storage warehouses. Normally peaks in October each year, so we normally don't see the same sort of peak around July 4 that we do with produce. But looking at the end of May volumes for all of those things in cold storage, volumes are about 13% lower year to date compared to the pre-pandemic year to date average. So we're definitely down compared to previous years. That translates to about 1,600 truckloads fewer per week. So we're sort of down on the cold storage side. Produce specifically, we normally see the volume of weekly truckloads between March 1 and July 4 increase by about 12% in the last 6 to 7 years. So about a 12% increase over that period of time. If June this year is the same as the average of the last 6 Junes, truckload produce this produce season will have only increased 1%. So we're definitely going to see less produce volumes based on current trends. We're also seeing fewer loads of cold storage volume. Having said that, we are anticipating some more volume in as opposed to previous grilling seasons. But I don't know if that'll be enough to move the needle.
I do like a good grilling season.
It's true.
No, I mean, I think the chart you showed earlier in the show, Dean, is something that I've been watching very closely, which is how we're tracking towards that 18 peak. You know, where I think right around day 185, which I think was right after the 4th of July holiday that year, rates started sliding downward. That was previously the high water mark. And we've fallen a few cents below that, but this recent bump has us trending towards there. So, you know, this is a very important 20 to 30 days of the year as we lead into that holiday, because things do slow down afterwards, right?
Yeah, I mean, we've been saying on quite a few shows now and on our Sirius XM radio shows that 2021 looks more like an outlier, in particular in the produce market when you look at the volumes. So it's definitely not a year I'd be comparing to gauge the success of this year. But 18 has been a very familiar year for both dry van, reefer, and flatbed in particular. When you look at load posts, and load posts in particular are tracking very closely with 18 of all the years.
Yeah, I mean, I think the big wild card, and it's been beaten to death at this point, is just diesel, right? I mean, we saw another 16-cent bump last night. Driving in this morning, as I mentioned before the show, gasoline is over $5 in Ohio for the first time ever. I mean, again, we have pretty low taxes, pretty low gas prices, you know, relative to some of the West Coast and even like Pennsylvania, our neighbor. And I saw diesel bumping up against $5.99. I saw it a little bit over $6 on some of the highway stops this morning. So that will continue to put downward pressure on rates throughout the summer. I mean, a lot of people have been asking, when do we expect relief? And I don't have a good answer, even with the energy background. I don't have a great answer to that.
Yeah. Certainly it sounds like a real capacity issue, notwithstanding some of the other market forces regionally, but it just seems like nationally, even though drill rig counts are going up, it just seems like we have less capacity this market cycle than we've had in previous years. So that's whether that's just an exodus of refiners from the industry during the pandemic or not, I'm not sure, but there's certainly fewer refiners making diesel.
Well, I mean, it's $6 a gallon. I don't know. You have to back into what that means on a wholesale price. I guess it's the EIA numbers are pretty close approximation nationally at $5.70.
Right.
Are you that incentivized? I mean, it's a delicate balance, and fracking has changed a lot of that. Where were we at, Dean, last week? I'm sure you said it. Load post volumes for dry van, even though it was a short week.
I can pull that up really quickly. Load post volumes for dry van loads and trucks. Load post volumes last week were at about 1.2 million. This week about 1.1 million.
So even missing a business day, basically both weeks miss a business day. I know technically it's only last week.
Right.
So that's 6 straight weeks in a row of over 1 million load posts.
Correct.
For dry van.
In fact, I'm going back. I can go back to week 10. Yeah, there was only a couple of weeks where it was under 1 million loads this year.
Yeah.
Very solid numbers.
It's interesting to me that you're not seeing the same wedge effect in flatbed prices that you are in dry van and reefer. Where dry van and reefer, I think that a lot of folks attribute the lowered line haul rates to the increase in diesel prices, and that argument that you make, Ken, about like there's a fixed shipper budget, and if more of it gets eaten up by fuel, less of it goes to line haul. But you don't see that same effect in flatbed.
I bet the flatbeds are negotiated completely different, right? So,
Okay.
I mean, they're kind of negotiated on a one-off, itemized type.
A lot of accessorials.
A lot of accessorials. I think shippers are, much in the way that the stuff on the flat, like there's one of the kind of my mentors in the freight space said you can look at what's at the back of the truck and how that's purchased, and that's a pretty good proxy in a lot of cases for how that transportation's procured, right? So if it's just FAK palletized generic freight, that trucking tends to be purchased in a very generic commoditized way. If it's a removable gooseneck, overweight chase car type thing like that, so I'm playing golf in a couple weeks with a local flatbed carrier that we've actually had on the show before, and just to pick their brains about what they're seeing. And I mean, they'll do they have a name for it, but they'll send people out before they quote a price and run the route and see what stop signs might need to be moved. They'll get power lines temporarily cut off and potentially moved, and trees might need trimmed. So in that case, they're getting their fuel recapture.
Right.
It's not a 53 feet of paper, printer paper, or bottled water. So I think, go ahead, Dean.
I was say a lot of your flatbed loads, if they're not sort of regular, fairly commoditized items like shingles and things like that, that are going from a manufacturer to a warehouse, a lot of the flatbed volume is going into these sort of one-off project areas where it's hard to get trucks in. When you get in there, you've got cranes and forklifts that you've got to wait for. So there's a lot of time and money spent just moving a load compared to dry van and reefer.
That's a really good point, too, that we kind of in our Freight 101 talks that we'll do is it's almost flipped. Like the percentage contract for a flatbed is almost the opposite of dry van. And the only stuff that's really contract would be and I'm just mentioning this for familiarity, we don't have any relation, Owens Corning shipping shingles from their manufacturing facility to Lowe's. They'll have a contract most likely for that. But if they're sending sticks and bricks to a Ryan Homes allotment or a Pulte Homes allotment, that's not going to necessarily be contracted. It might be contracted for that tract home build, right, for a 6-month project, and say, the transportation is blank for that. They might do it that way, but But yeah, you can always look to flatbed though to see sort of seasonal pressures and how they're being applied, and it's almost like a sense of normalcy. Because if you normalize out some of the industrial stuff and some of the energy things, you can get a pretty pure sense of what's happening, kind of in a market cyclic.
And unlike unlike dry van and reefer, right, it's a pretty dedicated capacity sector. It's hard to interchange between the other, although you can carry produce on a flatbed, as we talked about last week. It's not common. So you generally see some interchange between dry van and reefer over the course of the year, but not so much with flatbed.
Yeah, that's right. And again, we're still seeing ample volume in the spot market. So again, I think my hypothesis has been, at least for the last month and a half, that brokers being very successful with RFPs will protect the spot market from kind of the barren wasteland that tends to happen in a 2016. And what I mean by that is they've secured their place on the routing guide with a lot of shippers, and they need to move that freight in the spot market. So that's why I think you're still seeing over 1 million dry van load posts per week.
Yeah. And in flatbed, we're seeing well in excess of 1.5 million, consistently in the flatbed market. It was a little bit heavier weighted towards March this year, but when you look at it over the course of the year, the flatbed load post volumes are tracking really closely with 18 and last year. Very similar years, and very different to every other year.
Yeah. Do we have time for a listener question?
Yeah, sure.
We have a question from Sukhpreet. When do you think spot rates and volume will start going up again, and what do you think may cause an uptick? I mean, they've gone up a little bit. I mean, it's not wild, but the breakneck fall has been arrested and it's bounced, and whether or not it's just sort of, I know it's a bad phrase, but a dead cat bounce versus a more sustained.
Here we go.
Yeah.
Let's pick up the freight media lexicon here. It's been a dead cat bounce to stop the bloodbath of the freight recession that happened in Freight Alley. So I'll take a swag at this.
Sure.
I think I would strongly encourage you not to pay attention to the noise in this space, right? This market is highly cyclic. So it goes up and it goes down. And if the term you use to describe every single time the market flips every 12 to 24 months is recession, that's fine. I mean, that's technically correct, right? That's a word that means things going down or receding. So if that's what makes you comfortable, okay, let's just level set that the market is correcting. It always goes up and comes back down, or at least it has over the observable history that the three of us on this call have experience with. So what typically happens in these cycles, right? Think about if you threw like a ball on a bungee cord. If you just threw it a little bit, it would come back at you relatively. I mean, I have a physicist on this call, so Ned, just plug your ears for a minute. But if you throw it gently, it'll come back at you rather gently. Right. But if you're Randy Johnson or Roger Clemens and you pipe that ball as hard as you possibly can, it's going to come back and smack you in the face, right? So what happens in these markets is, to the extent that they become overbought or oversold, and we've been talking about this for like 2.5 years now, they will more violently correct back. And to me, the shock isn't that the market came down this year. That was bound to happen. It was bound to happen at some point.
Right.
To me, the shock is that it kind of stopped where it did, frankly, which is still above the all-time highs of 2018. So again, just to reiterate what I believe will happen, I think we'll continue to see strength over these next 20 to 30 days. I do think we'll probably see things slide back a bit after the 4th as it slows down. That's typically when you have ocean activity and drayage activity and intermodal activity. But I would be looking towards Q4/Q1 of next year to see any sort of market cycle uptick. Keep in mind, we were in the good times for 2 years.
Yep.
So if we're in the bad times for a year, that's not that bad of a deal. And again, I can say that that's a platitude to the small owner operator that might go out of business or have to go lease onto a company fleet. But there are good times and there are bad times. This is not an industry that has remained stable in any way from a feast or famine perspective.
It's dynamically stable, though, right? Like, absent the fact that we're correcting back now to levels that are above where we were traditionally. I mean, that graph, I'm trying to remember the graph that you showed where it was nominal dollars even, so not even real dollars. The cycle from, I think, 2015 through 2019, it just kept coming back to the same place, right? And that's what I mean by dynamically stable.
Yeah, and that's interesting, right? So why is that? I mean, we could talk for hours about that.
Right.
And what I would call that, I mean, you call that a more technical term. To me, that's like, have we seen any systemic inflation in the spot market? And that's like a huge, to me, that was the most interesting thing about from 16 until 19, we crossed through, to Ned's point, the same spot. And what he means by that is we traveled, that's like a roller coaster. You leave the station and you might go up and down a lot, but you still end at the station for the most part. I'm sure someone will write in and say, you know, DAT doesn't know that some roller coasters end at a different spot. Okay, you got me. So you went all the way down in 16 to the depths of what I would consider a much worse. Like, to me, that's probably the only true freight recession in our time series. So depths of 16, the all-time highs we thought in 18. And then in 19, when it settled back down, it passed through the same, what was it, $1.50-ish a mile, excluding fuel for dry van. But what didn't happen there was large driver pay increases, the changes in fuel, the changes in operating costs. We're in a post-ELD era. None of that happened before. So prices could come back down, and carriers were largely burdened by the same cost regime that they had prior to the ups and downs. You've seen 3 to 4 rounds of driver pay increases. Insurance has gone up. ELDs have completely changed the efficiency game. And you have honestly, like, the hidden story in fuel is kind of like the ebbing back of fuel discount programs. I don't know. We've talked about that quite a bit, but This market doesn't seem sustainable to $1.50, $1.40, $1.30 a mile long term. But what do you think, Dean?
Yeah, I was just looking at the rates, operating costs for an owner-operator today, that same spreadsheet we've been tracking for about a year. It's interesting that dry van line haul rates are plateauing at about the same cost to run an owner-operator truck, dry van. So if you think about 205 as a line haul rate, excluding fuel, that's about where you are running a truck, single truck running 110,000 miles a year, using all sort of the standard operating costs that ATRI push out each year. So I think that we talked about this last week. Would the floor price be the increased operating costs of a small truck operator? For the last 3 weeks, it's certainly holding around that level.
Yeah. So we'll see. I do, and I've been I think fairly consistent to the sense that I can articulate what I'm actually thinking most of the day. I think where this market corrects back upwards will set a rather long-term kind of new baseline. And what I mean by that is you very rarely see driver pay increases clawed back, but what you will see is just lengthy periods of time without them, right? So you might go 2, 3, 4 years without a material increase in driver pay.
Yeah, to torture that analogy that you had about the ball, there's this idea of plastic deformation where if you stretch something enough, it stays stretched, right? It doesn't go back to where it was before. And I think that we entered that like plastic deformation range with the driver pay increases and just the effects of the pandemic, where it's not going to go exactly back to where it was before. Like some lengthening has been baked in.
Mm-hmm. And we'll see where that settles. And we'll see where we go from here, right? I mean, there's going to be another, shocker, right? I can pre-print the headlines for you. Sometime in 2023, maybe 2024, we're going to reach new all-time highs. It's going to be the new boon of freight. And then sometime in 2024, again, save yourself the printing costs, buy the paper now. We're going to enter another freight down cycle.
Yeah.
I mean, spoiler alert. Sorry for those who are just kind of waiting to see how it comes, but that's what's going to happen.
Right.
All right. One more question.
Yeah, we've got a question from Zed Lee. What does it mean if there are not enough products on market for consumers? Will freight rates go down and fuel prices go up? I think that those are kind of unrelated questions, or unrelated. I don't know. Products being on shelves, like there's two parts of that. Either not enough is being produced or not enough is in the right place, right? And I think the not enough is in the right place is the thing that could have an implication. But if there's not enough that's in the right place, then, at least to me, that would imply that shippers are more willing to pay more to get products on shelves so that they could sell them.
Yeah, I mean, it's still a huge inventory mismatch issue. Like, good luck getting golf clubs, but if you want a TV right now, every major retailer in North America is like way overstocked with televisions. Just go to any website that like shows deals for electronics, and you'll just be inundated with like a 75-inch TV for $300 because they overbought, and then they all got delivered, and then the tax time was passed, and President's Day and Memorial Day all passed. So, but again, I'm looking for a new golf club, can't find one. You're looking for a washer dryer, still can't find one. It's going to be that way for a while. The second part of the question, real quick, I would expect this recent 16 cent or so, we talked about it before the show, we'll probably see instantaneously 3 to 4 cents come out of the spot market this week, would be my guess. So fuel rates going up, put downward pressure on spot rates. And I don't know that the seasonal pressure this year, based on everything we just talked about for 35 minutes, will be enough to overcome that acute pressure of fuel. And again, we'll say it once before we get the plugs. If you ask a shipper, there is nothing recessionary about the current freight environment. They are paying more for freight than they have arguably ever. I mean, I can't think of a time in recent memory where you'd be paying more for freight in a real kind of a nominal dollar perspective. Right. When you take fuel, go ahead.
I mean, also in a real dollar perspective.
Yeah, I don't know how true that is, so I didn't want to say it because I don't know like what fuel prices were like in 15. I know fuel prices were high, rates were high, so I don't know exactly if that's true. But in a nominal dollar perspective, rates plus fuel, they are paying out through the nose for transportation right now. So, all right, plugs.
Shout outs. Yep.
Yeah, we'll be on Landline now tomorrow evening at 7 p.m. Eastern on Road Dog Radio, Sirius XM channel 146. I'll be on tomorrow morning on Sales Chatter with Dan Deegan and DJ Flores at 9 a.m. Eastern. You can connect with them on LinkedIn. And then on Thursday, I'll be on Jimmy Mack talking trucking, Thursday 8 a.m. on channel 146. I think Chris Kaplis has got a new freight vine out talking about resilient transportation portfolios. I think that was out last week, so you can probably catch that with Kevin Zweier on the podcast channel.
All righty. We will have more information in the coming weeks, but our annual user conference is on this year. It'll be in Austin this fall. We're getting really excited about that. If you have a good idea for a topic or a session or something like that, maybe have that on the top of your mind or shoot it over to Ask IQ. We love to get customers and partners involved, but we will have more information to share in the coming weeks. But with that, we will see everyone next week. We hope you have a great week.
Yeah.
And stay safe out there. Bye, everyone.
Bye, everybody.